G'day expats and welcome to another episode of Expat Chat. Expat Chat episode number 51. We're into the second half century, James. And for the folks out there who are joining us, I'm joined by my colleague and mate, James Ridley, who's the Managing Director for the Asia Pacific region, running our office in Australia and looking after the fort back home. G'day, James.
G'day, Brett. How you going, mate? How's the sandpit? And mate, before you jump in, everyone that's listening today, joined by Brett Evans, as always, the Managing Director and founder for Atlas. It's based over in the desert, I want to say, or the sandpit, Dubai, and he looks after the EMEA region. But mate, how's things going on over there at the moment?
Mate, as you can tell by the T-shirt, it's Physio Day today. So
Yes.
when I'm wearing the Atlas Polo, it's a bit of a giveaway. It's a sprint to the end of financial year. Yeah, even though we've been sending lots of emails out to clients, reminding them everyone's doing things late. You know, it's when you get emails from clients saying, can I transfer money on the 28th? It's like, well, you can transfer it, but I'm not going to guarantee it's going to get there or they're going to allocate it to your account. So
I know. It is that time of the year where we do get quite busy finalising those sort of last minute strategy pieces for select clients. I know everyone in our industry, when you talk to sort of colleagues, mates that are financial planners, it's funny, every office is the exact same, sort of scrambling to the last second. And then, you know, it obviously is a bit of a lull, but then it obviously picks up on the tax side because now it's tax time. Everyone wants to get their tax thing squared away.
S290s and stuff. And I think, you know, this client said, look, it's not up to us. You know, I'll work to midnight on 30th of June if I have to. The problem is it's the platform providers and they have their cut-off times and those sort of things. So unfortunately, that's what holds us back in terms of trying to get things done at the last minute. As folks who've been listening to the podcast know, you know, I've been telling everyone for the last 2 months, don't treat it like a university assignment. Don't hand it in at 4:59 p.m. on a Friday. Get your ducks in line, get your ducks in order. So, mate, I thought what we do today is just do a bit of a end of financial year wrap up and review. We had a webinar last night, which was great. Lots of folks on that one there. So let's run through it and get the disclaimer out of the way. So all information that you are about to hear come out of James and I's mouth. It's essentially, you know, fun, entertainment, have a laugh. Don't treat it as personal advice. And if you do need personal advice, speak to a professional like Atlas.
Nice, mate. Silky smooth. And I guess a good time to sort of take stock of, you know, how the last 6 months have gone. I know it's the end of the financial year, but, you know, we've entered this year and there's just, you know, those key themes hanging around, but taking stock of sort of the world economy, the Australian economy, property, interest rates, shares, super. There's just a lot going on, isn't there?
Mate, I think there's a great saying that Aussies will know and any other country will not know that typifies this market we're going through right now. It's a game of two halves. And if you think about it, from 1 July to 31 December, nice. It was a very nice period of time. 1 January to 30 June, not so nice. So, and I think, you know, as I said on the webinar last night, I think the second half of this year is going to show very much like last year, you know, because the market, like my 10-year-old child, will listen to whoever's talking or won't listen to whoever's talking, I guess, depending on how you phrase that. But at the moment, we are in a bit of a news vacuum. So the only people talking are Reserve Bank governors. And their job is to try and talk the economy down, to try and slow it down without having to use monetary policy. So they're talking, you know, they're using the R word, recession, and all that sort of stuff. So to me, they're trying to scare the bejesus out of mum and dads to stop spending, to try and bring those inflation numbers down. In saying that, you know, we saw UK's numbers come out yesterday, up 9.1% inflation. Yeah. So
they'll hit I reckon they'll hit 10% by the end of the year. I think that's an expectation. Yeah. So,
and then look, that's what we run through on the call. We went through and talked about international inflation, international interest rates, and Australian inflation, Australian interest rates. And one of the things I was saying to everyone was the situation right here now with interest rates and inflation is us paying the price for the central banks getting it wrong last year. You know, they should have been more aggressive. The Bank of England actually raised rates in December, but then they stopped.
Yeah, I'm wondering if in hindsight they wish they just kept going. I mean, yes, they probably would have been one of the countries that just did it first, almost. I mean, no, RBNZ actually went pretty quickly as well. But it was interesting to see Jerome Powell when he did his talk yesterday in front of sort of the Senate. It was a very long talk, but there was almost something in there for everyone, to be honest. More so a case where he was addressing the masses, he was addressing sort of different areas, sectors, those sort of things. And you could almost take what you want from it, to be honest. You could take positive things, you could take negative things. Like it's a very neutral sort of talk that he made that you could take from it that the remainder of the year, they're not going to be as hawkish and as aggressive, but there are still rate rises coming naturally.
Yeah. And I think the last numbers I saw, the market's pricing in 3.8 by the end of the year, which certainly is quite a lot higher than where it is right now.
Yeah.
And as I said on the call last night, I said if everyone starts working out their mortgages, if you're suddenly paying 2.5, 3, add another 2% on that and see how you feel, because that's a real reality right now.
Well, good topic actually, because and I mean, not something I could probably elaborate on, something we should actually, we'll pin Jeremy down on when we get over in Dubai actually. But there's this concept of mortgage prisoners. I don't know if you've ever heard of it, but it's like interest rates are going up. So how you're assessed is very different. In 6 months' time compared to how you assessed last year, because interest rates were a lot different. So even if you want to refinance sometimes at a better rate, it can be quite difficult. So, it's those considerations as well. But I think, we know interest rates are going up naturally. I think we'll get another one, obviously, in 10 days, 11 days when the RBA meets again. And
look, to me, as I said in the end, and I won't try and repeat myself too much, because I'll put the link in the show notes below to the webinar and the slides.
Yes.
But like we said, one of the charts I love showing clients is the current mortgage rates in situ, like what people are paying right now and what the banks are offering in terms of new loans. So from an ROI point of view, from a cash flow point of view, I said this to everyone on the call, pick up the phone, talk to your bank, call them and say, sharpen my rate or I'm running away. The banks are very hungry right now for market share, net interest margin still record low. The only way they can grow their book is new business. So there will be someone out there who will offer you better terms than what you're paying right now. So make it easy. Try your bank, see what they do. Yeah. Even if they just knock it by 20, 30 basis points, that's money in your pocket. And it doesn't sound like a lot, but I tell you what, if we are putting another 2% on people's mortgages, you're to be thankful if you can get 25, 50 bips off your mortgage rate. So it's really, I mean, I think there's a couple of simple things people can do because that sort of stuff is, to me, the first 50 would have hurt. The second 50 is, going to be, that sucker punch. The third one is the one you got to watch out for. If that's as high as 50, that's the nail in the coffin for a lot of folks out there. And Australian press is full of it today, saying how people are surprised, that rates are going up. And it's like, well, I get that not everyone watches the markets like we do. But, how can you expect rates to remain at 0.1% for
that's
that duration?
I mean, we've just got addicted to this cheap money. And, we haven't had cheap money for very long either, to be honest. Getting back to a normal, say, mortgage rate of 4.5 to 5%, that's normal. That is normal. We seem to think everything that we're experiencing right now in terms of these cheap interest rates, that's normal. That's not at all. And I think a lot of people that have entered the property market for the first time, I would assume, have had the mindset that, interest rates are going to stay pretty low. This is pretty affordable. But the reality is that, as soon as their mortgage rate is 4.5, 5%, a lot of people are really going to struggle to sort of meet that regular repayment. So it'll be very interesting to see what happens next year. But that is a normal sort of interest rate that we've had for the last 10, 15 years, however you look at it. So yes, I think a lot of new borrowers are going to be caught out and not realizing, oh God, okay, you do need to make concessions when you have a mortgage.
2010 was the last time, and it's been a lot of water under the bridge. And I think, to me, folks are asking, they're saying, oh, I'm watching property, but it's not moving yet. It's like, well, no. If you look at a standard default period, it's 90 days, and then you got mortgage in possession and stuff. And as I said on the call last night, to me, it's the fourth quarter of this year, first quarter of next year, that we're going to get that window into the viability, sustainability, and then the how bad or not the Australian property market is at the present point in time. Because unfortunately, we look at aggregated numbers, and on average, the Australian households are fine. But we know that there's always those exceptions, 2 or 3 standard deviations out, who aren't fine. They're hurting now. So let alone with this next bit
Exactly
coming.
right.
And if we had interest rate rises, but inflation was okay, no dramas. But when you're paying an extra 2% of your mortgage and you're paying $12 for a lettuce and $2.50 for petrol,
Yeah.
things narrow up on the cash flow side very quickly.
I know, mate. It's listen, I've changed out the lettuce. I'm having Brussels sprouts at the moment.
Nice.
It's a big change. But you're right, mate. And I guess I can't wait till after June because we move away from what we call the news vacuum,
Yep.
where there's not much new data coming out, and then we move into earnings season. So it'd be really good to see, especially the US market. US market, 65% of world share markets, how a lot of those companies have actually performed, especially. We all know how the tech sector actually performs through these periods, but even just sort of your general old school core businesses as well. It'd be good to see how those sort of legacy industries have performed for the first 6 months, as well as in Australia.
Yeah,
that's right. And because, it might give us a bit of an insight into, okay, what can we expect for the next 6 months? Off the back of earnings season, you might actually see markets lift if it hasn't been too bad in the US and as well as in Australia. I think Australia will do a lot better than the US this year. But I guess it just gives us that lens into what we might expect. Also want to know how our economy has sort of grown or contracted in the quarter, June quarter, because March quarter, we still grew, but God, we had a lot to fight up against. We had, remember the floods, Queensland, New South Wales, that absolutely smashed the labour market, caused obviously issues with just logistics and crops. We also had the Omicron wave just sweeping through. So the fact that our economy still grew with those key challenges in March, I actually think there'll be a good result in June, to be honest, from a GDP perspective. That's my prediction anyway, but we don't see that figure for a very long time.
And that's actually, you've touched on a very good point, and that's why the RBA is at a disadvantage to the US Fed, because the US Fed gets monthly figures and they can react to those monthly figures, whereas the RBA has to wait for 3 months before they get those numbers signed off. And, when we look at the rate decision tomorrow, that's based on data back to April. So, not tomorrow, next month, I should say. So,
I know. Yep.
So
I know that's right.
And it's like, it is like driving down the highway, looking in the revision mirror, using that to determine whether you turn left or right, going straight ahead. Yeah, everything's historical.
And I guess you can understand from, to a degree, central bank's perspective, okay, Governor Lowe, he's relying on data from 3 or 4 months ago. That's why he might do larger interest rates than the market expects. Not 0.25, but 0.5%, because I'm actually trying to cover off on the last 3 months rather than that month from that data point.
Yeah, he's trying to anticipate the area forward. And I think that's the biggest issue, and why the financial markets got it right in October last year and he got it wrong, because we could all see inflation was baked into, it wasn't transitory, it was endemic inside the economy. But they go, no, we're good, because in October, they're looking at data from July. So, and it's like that, we always joke about, the Bureau of Meteorology. They say it's fine, and look out the window and there's this big black cloud coming. And it's like, it's not fine. And then at the last minute, oh no, there's a storm warning. I think you need to balance off data with pragmatic, sort of interpretation. Now, obviously, they have a matrix of decisions that help them govern what they do. And they need to work out. I think the system's broken. Personally, I think they need to change how that whole decision-making process works, and the factors and the data that they rely upon in order to provide something a bit more real time.
Yeah, well, I think you're right. I think the data needs to be more updated rather than relying on the previous quarter, and you're getting that, 2 or 3 months down the track. It needs to be more up to date, and maybe only ideally a couple of weeks old. But whether Australia has the kind of infrastructure to produce that kind of data like that, not sure. Not sure.
I mean, I think the problem is probably, and I've never worked for the public service, but and those on the call may have done this. I think our systems are so old. That's the problem.
They definitely are. I know our banking, to a degree, is a little bit better than the US, but when it comes to financial instruments, technology in that regard, we're usually 5 or 10 years behind the US, to be honest. I think that's just an accepted norm.
Yeah, if you work for the government on the call, tell me if you were using Windows 98. I reckon there'll be a lot of people who would still be using it. I remember working for Citigroup in a past life, and they refuse to update their systems because they're afraid that any updates are going to crash the system. So
Yeah.
I reckon from a federal government point of view, their systems will be even older again. I don't know. And I know, you know, the ABS has always complained about headcount numbers and resources and those sort of things. So data, you know, computers can do the heavy lifting.
Yeah.
I think they need to revisit that anyway. So that's
absolutely.
my 2 cents.
And what about, I mean, what's your thoughts on the world economy as a whole? I mean, yes, dominated by the US, but what are your thoughts on the UK, Euro area, especially with the Russia-Ukraine sort of situation is kicking on?
Ukraine's not going away anytime soon.
Yep.
What's happening consumer confidence is plunging in Europe. Whether we see that translate into their inflation numbers, we'll have to wait and see. UK's obviously got massive inflation issues. To me, and I am going to use the recession word, not for Australia. I think Australia might be able to avoid it or be very close. I do think there is a high chance of it occurring in UK and Europe, but then I can see the central banks quickly following with a rate cut to try and unwind or take their foot off the brakes. And to me, being in a recession is not a bad thing. We associate it with Paul Keating, the recession we had to have and all that sort of stuff. Most people would never know we're in a recession unless we told them. And it's a technical measure for 2 quarters.
That's exactly right. And I just wanted to tell everyone what is the theoretical definition of a recession. And you're right. It's 2 back-to-back quarters where the economy or the local economy contracts. So you don't have essentially GDP growth. The GDP of that country actually contracts. So it's a negative figure compared to the previous quarter, but you have 2 back-to-back quarters. So that's 6 months. We had it through COVID, but we pulled out of it straight away. And, you know, just because we might be in a recession, I guess it doesn't correlate directly to share markets, you know, switching into a bear market. There's not, there are some correlations to that in the past, but it isn't very strong at all. And then you look at a bear market, you know, the definition of a bear market is when a share market or an index has dropped more than 20%. So, and then, you know, obviously it pulls out of it. Okay, you're in a bear market, quickest bear market we've probably seen, and then we're back out of it. So that's sort of the technical definitions when you hear the words recession, what it actually means, and bear market. But most people wouldn't actually know we're in a recession until it's behind us and go, oh, okay, that was a recession.
The only time they really notice it is if we have successive quarters, you know, like 6, 12, 24 months, sort of like what Japan goes through. That would certainly be felt at the home level. But I don't think we're going to have that. I think, you know, right now it's sort of overcooked, it's undercooked, it's overcooked, it's undercooked.
Can't get it just right.
Yeah, and it is Goldilocks. It is, you know, too hot, too cold, just right. You know, it's finding that middle balance. And, you know, the central bank, certainly the RBA, has the battle of trying to be competitive on the world scheme too. You know, if we don't raise rates and everyone else does, then Aussie dollar comes under pressure. That's going to be a big part of it. We're in 69s today, back again. As I said in the call, I can see the AUD sitting between 65 and say 71 over the next 6 to 12 months, because certainly
commodity prices won't help that.
Well, I think the difficult one is China. So now they're trying to fire up the economy again. They're actually cutting mortgage rates, believe it or not. Everyone else is raising official cash rates. China's cutting mortgage rates.
But like the experience that I've talked to clients about, especially in like Shanghai and stuff, when they've done these snap break sort of lockdowns. Yeah. Like I remember a client told me a story where there's literally trucks that got caught in the shutdown, and there's truck drivers living out of their trucks on the street, not allowed to go anywhere. Like that's that's just ridiculous. I mean, have some common sense, surely. And unfortunately, I don't think those lockdowns will change too much. This is my opinion. It's not coming from any data. I don't think it's going to change too much until probably start of next year, to be honest. I think they're still going to pursue this because the president still has a lot of support. There's a lot of fear-mongering over there and a lot of propaganda. Plus, their vaccine, it's proven that it's not as effective as, you know, the vaccines that we've probably all had, you know, your Pfizer's, your Moderna's, those sort of ones. Yeah, there's a bit playing into that.
Look, it is, and that's my only caveat with the Australian dollar. If we see China's economy slow, demand for iron ore, coal, those things will drop. That'll lend into a recession from the Australian point of view. You know, we had that contraction. Obviously, resources and exports make such a large part of our GDP numbers. So, and then if the commodity prices fall, there's an intrinsic link between commodity prices and the Australian dollar. Commodity prices are strong. Everyone remember back in 2010, no, how old's Anya? 2011. So Australian dollar got to parity and above in 2012, 2013, I think it was. So, and that's when we had that commodity boom going on. The biggest thing we see right now is the commodity boom's there, but the confidence is not. But if that commodity boom comes back, you know, you're going to see the dollar certainly under pressure. And if the RBA is not raising at the same rate as US Fed, Bank of England, ECB, that also is going to put pressure on the dollar. So this could be actually a great opportunity for expats coming up over the next 6 months. You know, it's going to be interesting to see where that dollar plays out. We're at 69, could be at 67, could be at 65. But like we keep saying to everyone, dollar cost average, folks, transfer, don't try on the time the market. Today's a great price, 69. Take a chunk. Don't do everything.
Exactly right.
And then if it pops back to 72, you'll look back and go, oh, gee, 69 was a good deal. You just don't know. You don't know what's going to happen. Vladimir Putin could drop dead tomorrow and the world embraces and rejoices and markets go up and everything goes up and off we go.
I think they would. I think the elites that he's surrounded by, they're all too scared of him. But God, he looks a bit, he doesn't look well, to be honest. So
I reckon he's toasted. He's toasted.
You see a lot of rumors about him potentially having cancer. And it's D-Day is coming, and this is just his final out, to be honest, what he's doing.
Cancer,
so he won't
Alzheimer's.
That's right. Won't have to clean up the mess. Just be like, all right, that's all right. Did my part.
Done.
Yeah, exactly. But mate, listen, good review there. I mean, economy, it'd be very interesting to see what sort of comes about in the next sort of 6 months. Earnings season will help provide a lens into the next 6 months, and knowing the fact that, okay, we're entering the next 6 months, we know inflation's high, we know interest rates, tightening cycle, okay, we know all that, whether it means that markets have digested the first 6 months and go, okay, we've set expectations for the next 6 months. We know, rates will coming up, but they're mostly priced in now to a degree in share market. So it just means a bit of sidestepping, a few good days, a few bad days. If markets are calm, that's when we should be nervous. Markets are always volatile. So volatility is the one sort of, I suppose, ongoing theme that we've always known.
Yeah. And I think let's break it down into quarters for folks out there so they can keep an eye on their calendars. Third quarter this year kicks off 1 July. That's going to be all about equities. And then fourth quarter this year, first quarter next year. So 1 October through to 31st of March, watch the property market in Australia. That's when you're going to get a real insight into how Australia's going and what's going on. So,
yeah.
And I think we leave it there. A couple of little things down below. We'll have links to the webinar from last night, the show notes. Obviously, keep those questions coming through, folks, for questions you want raised on the podcast. And last of all, keep shedding the love on the reviews for these guys, because that does help us get the message out there.
Absolutely, mate. All right, Brett, I'll let you enjoy your day. Great to connect.
Cheers. Thanks, mate. Look after yourself.
Good, mate.
See you, mate.